All right, everyone, welcome back to another episode of Bell Curve. Before we jump in, quick disclaimer, the views expressed by my co-host today are their personal views and they do not represent the views of any organization with which the co-hosts are associated with. Nothing in the episode is construed or relied upon as financial, technical, tax, legal, or other advice. You know the deal. Now, let's jump into the episode.
All right, everyone, welcome back to the first inaugural episode of 0x Bell Curve. This is the mashup that you didn't know you needed between Dan Smith and Westie here from the Blockworks Analysts team and the sometimes host of 0x Research. So, guys, welcome to the show.
Thank you.
Appreciate it.
Yeah. All right, why don't we start with kind of a high-level topic today, but then we can delve down into some specifics. So I want to talk to you guys and get your high-level thoughts on airdrops. So airdrops have been getting some renewed interest this week. There's been some sort of funny activity going on both Stargate and ZK Sync for the last couple of days. So in the past 7 days, there's been $480 million in bridge volume on Stargate. And in the last 7 days, $195 million worth of volume incoming in ZK Sync, the ZK Sync era at number 2. And the general consensus is that this is sibling. And it kind of just raises the question of maybe we could just have a discussion about sort of what should the function of airdrops be. I think we saw a pretty interesting battle and very different strategies play out earlier this year between Arbitrum and Optimism. Both had very different strategies. And I just kind of put the high-level question to both of you guys. How do you generally think of airdrops if you're writing like a best-in-class sort of playbook for, let's say, an aspiring roll-up? How would you advise them to do it?
Yeah, it's an interesting question because it's pretty open-ended and quite frankly unanswered at this point. Now, you've seen the OG airdrops where it's like use our protocol from the early days and then we'll reward users. This is kind of the Uniswap model, like they airdrop to their LPs. Then you kind of saw an evolution of, hey, instead of just giving the token away to people who have used the protocol, why don't we incentivize continued use? And so you saw like Compound kind of pioneer this by incentivizing borrowers with comp tokens. And then ever since that, you saw explosion of DeFi summer and a whole onslaught of different ways that protocols can throw tokens at users and attempt to attract sticky users. The Stargate example is a pretty hilarious one because if you go over to DeFi Llama, click their Bridges tab, and just check out the activity for various bridges, and they have pretty much every bridge listed here. Stargate is far and away the leader when it comes to the number of transactions, but depending on the day, they don't always even lead in 24-hour bridge volume. But the number of transactions is where things just get hilarious. So just looking at today is July 6th, so random day, but this is shamelessly consistent. If you go over to this tab, far right says number of transactions in the last 24 hours. So coming in at third is Hop Protocol with an honest 6,700 transactions. Coming in at second is currently ZK Sync, their bridge, and that comes in second at 8,300 transactions. And then coming in first by an absolute mile is Stargate with 282,000 transactions. Like it's just not even close. And so it's like the size gap between Stargate and everybody else. Even if you combined up every bridge and said how many transactions in the last 24 hours, it's still an order of a magnitude difference. So it's just it's funny to kind of watch these things go. And funny enough, I was actually tearing through some Avalanche data earlier this week, and the most frequently used transaction contract, like if you like basically look at activity based on the to address, so like the receiving contract or address of a transaction, since the start of the year, the most hit contract is none other than the Stargate bridge. So it's just funny to see where this stretches to, and it comes to like pumping these daily active user numbers. But basically, this is something that exists, and we're gonna have to kind of deal with. But at the end of the day, if Stargate successfully attracts a host of users to their platform by doing this, then you know what? Maybe it's a good thing.
Yeah, to me, there's basically two major buckets that you want when it comes to an airdrop. The first is incentivizing sticky activity. I think a lot of airdrops in the past have incentivized activity in general, but as soon as the airdrop ended, all the activity sort of went away. So I think focusing on more like sticky activity, and that can be done having like multiple airdrops, kind of like Blur has like their seasons. So doing it over time, I think is a good way to do that. As well as like, I think sometimes, having the allure of a future airdrop is sometimes better than having a specific airdrop itself, because then, people can basically do math and understand what their ROI is and how much investment they need to put in. Whereas if it's sort of like invisible, people will put up more capital at risk and have more activity over a longer period of time. And so I think that incentivizes more sticky activity. And then beyond that is like finding quality holders of your token. So I think with that comes finding actual like organic users of your protocol. If you have something like Arbitrum's airdrop, there was a lot of like third parties who were able to look into the data when it came to the airdrop and found that a lot of addresses that were very clearly sibling the airdrop were given like a pretty sizable portion of the airdrop ARB. And so being able to find quality token holders, like actual real organic users of the protocol who are less likely to like sell the token or more likely to accumulate and be good actors in the system. I think those are like the two key components to a quality airdrop.
I feel like it's this thing that's very easy to say in practice, very difficult to actually do. I guess you have to start high level from the perspective of the protocol, and you have to say, what do I want to incentivize? What is the action and outcome that I want to do? And then what's the best way to actually do that? I think right now, it's very popular to do these sort of post-mortem analyses on yield farming and say, oh my gosh, look at how much liquidity these protocols were giving away. Look at how much first of all, it cost them to acquire an average user. And by the way, everyone just started dumping the tokens. So this was a lose-lose. What a dumb thing for these protocols to do. I think the one shining benefit that yield farming had or airdrops have is that it's very simple. It's very simple. And I kind of have this one experience that I'm drawing on here, which is designing sales comp plans, which if there's like one or two of you out there who have tried to actually design a sales comp plan, you're nodding your head aggressively because it should be super easy. And it's one of the most difficult things to do and get right. But the guiding principle of a sales comp plan is that it should be extremely simple in terms of, if I sell X, this is how much I get paid. And I feel like that's the one, sort of guiding light just about in terms of how token incentives have played out so far. Now, I think it's a bear market, and bear markets are typically the time that you have cloud cover to fix things that are broken. People are thinking about adding a lot of complexity, which I think is good, but there's a dual-edged sword for complexity because you can get a lot more granular, but it also means there are a lot more assumptions when you make something complex, and you have a lot more room to be wrong. So I guess, what do you guys think about that kind of from a high level? And then let's try to get tactical and give protocols out there advice. Like, what are examples that you've seen protocols execute this well? And what kind of activity, when you say sticky activity, how do you actually end up doing that in practice?
Yeah, no, that's a really good point. And you kind of mentioned the trade-off between airdrops and like long-term liquidity provision. So if you think about somebody like Curve, they had a pretty good token allocation, 33% to team and investors with 67% to the DAO and community. So kind of the area you generally want to see. And they had actually a very small airdrop, but a very large portion of that went to like long-term liquidity provision. And to your point of what do I want, like what is important to my protocol, the answer to them was very much so liquidity, and as it is for most DEXs. So they kind of built a tokenomic system that says, all right, well, we need to pump out a ton of incentives, and then we're going to create some sort of like a locking mechanism that kind of reels back in some of those tokens. Of course, there's a whole box to unpack there about why their model works while a lot of these other VE token models failed. But broadly, they said, what's our most important thing? Liquidity. Well, let's go ahead and, design basically a token structure that is purchasing that into perpetuity is effectively what they did. And so that's kind of like an interesting model trading off between pure airdrops and long-term incentives. But when it comes to something that we've seen more recently, Blur kind of pioneered this point system where instead of just like accruing the tokens in real time, you're accruing points that will, as presumably was the idea, like these points will, increase the size of my airdrop. And so to Westie's point earlier, it's sometimes the allure of an airdrop is actually the most beneficial piece. And like we really saw that with Arbitrum where they're like, hey, a token's coming. 6 months, 8 months, 12 months later, the token finally shows up. And now that they've like gradually built up so much usership, then we are seeing a fairly sticky liquidity there. And I would probably say a large portion of Arbitrum's success is actually having apps worth using. Granted, most of them are like perpetual futures exchanges, but it's sticky nonetheless. Yeah, I guess there's a tip. If you want sticky liquidity, somehow incorporate gambling. But we're seeing that kind of spill over into the Solana ecosystem as well, right? So MarginFi just announced their point system model, which again, they didn't say it was for an airdrop, but that is presumably what these points are being racked up for. However, it's definitely not guaranteed. We saw, I believe, I'm afraid to say this name because I don't want to quote it wrong, but I believe it was EtherFi, and they kind of put out a point system. They tallied those up, and then they're like, hey, you can spend these points on some of our merch. And it's like, okay, that's not what we were going for. But so MarginFi is launching this point-based system. They're a lending protocol. So either lending assets to the protocol to, spin up the borrowing process, it gives you points, and borrowing assets from the protocol gets you points as well. And then lastly, you can like refer other people to the protocol to kind of like help promote the word of the protocol. And that gets you points as well. And so again, the intent or the idea of this is like, okay, if I earn enough points, that'll increase the size of my airdrop position. And so you've seen people kind of like compound their farming efforts by taking Jito Sol, which is Jito is like an LST provider based on Solana, taking that asset, depositing it into MarginFi, and then kind of like compounding, right? So you get Jito Sol exposure while depositing into MarginFi. It's kind of like a 2-for-1. So, is that the best way to do it? Still TBD really, but it is certainly the most popular way as of right now.
Yeah, I wish there was one example I could point to and say that's like a great example of an airdrop. I don't think we've kind of hit that yet. I think each and every one has had some sort of flaw with it. I think the best one has been Arbitrum to date, and I think that's just because you can look at the success that it's had after its airdrop, where even now it's number 2 in DEX volume to Ethereum, sometimes even passing it on certain days. And this is after incentives and the airdrop has been emitted. And so I think that's like a clear point to it being a successful airdrop, whether the allocation itself or having the airdrop be most of it all at once is a good idea. I think has yet to be determined, but I think for the most part it's been successful. And I would agree with Dan that things along the lines of Blur or what's happening with these Solana projects where like a point system where people like have a clear roadmap, clear KPIs of what it takes to get the airdrop, but at the same time not having some sort of clear ROI or clear, here's the number of tokens you're getting and this is how much dollars you're getting, allows for like more activity because sort of that unknown factor that Arbitrum had applies there where people don't know what they're getting, which means they're more likely to have higher amounts of activity. So overall, like if we can see Blur have sort of like Arbitrum have the same level of activity, if not more, following its airdrops, I think we can therefore point to that as like probably the most successful.
I'm curious, Westie, though, do you think that the Arbitrum airdrop's success was like would you, I don't know. So Arbitrum didn't really see a sharp drop off in like, in total transactions, users, like there was a bit of a decline, but nothing like, astronomical by any means. They still have high TVL, still have good activity. The DAO is still generating decent revenue from the sequencer. And would you say that that's like, how do you think the airdrop really plays into that? Like, I get the narrative that like, oh, there's a bit of a wealth effect, you airdrop everybody a few $1,000s, which is effectively what happened. And they're more likely to stick around and hang out there. And I see how that works for an L2. But L2's kind of had a bit of a privileged position, right? They raised at insane valuations and kind of came out predetermined to be, everybody gave that token a range between, I wouldn't say everybody, most sensible people gave that token somewhere an estimated price between like 80 cents and $1.20, right in line with, what we're seeing on FDV wise between other L2s or current market cap wise. And that's exactly where it came out and is quite frankly still trading. So they kind of had this ability to give everybody a few $1,000s, and plus that matters a bit more when you're, a base layer like an L1 or an L2, as opposed to, let's say, I was just a new DEX that I was launching on Ethereum, right? Like I just, how do you think the dynamics work there?
I mean, that's definitely a good point that it being an L2, especially one of the first L2s to go live and get adoption, I think that contributed a lot to it sort of gaining momentum. and the airdrop sort of continue that flywheel. But at the same time, like having an airdrop and specifically the allure of an airdrop, I know the Arbitrum airdrop was teased for like a year and a half prior to it even dropping. And so because of that, you're able to sort of create a flywheel on its own over time as more apps develop there, because they want to take advantage of all the people who are there to sidle the airdrop. And, you know, as more and more users go there, as more and more apps build there, you sort of build an ecosystem that becomes sustainable over time. And that is the goal of an airdrop, is to incentivize activity that is sticky, and you sort of create a flywheel where once you get rid of those incentives, it can sort of exist on its own. So I would say like the airdrop and the fact that it was teased for such a long time and that Arbitrum was able to gain that momentum as a result, that I would say it's successful, whether or not we're looking at the airdrop as an event specifically or all of the, like its incentives leading up to it.
I would agree with that. I hadn't really thought necessarily about the, obviously Arbitrum waited way longer than Optimism, but it's almost the analogy of maybe like HBO versus Netflix, where Netflix kind of dumps everything on you in one weekend, and then you watch it when season 2 comes out, you just can't remember anything, as opposed to Arbitrum is HBO, and each episode of Game of Thrones come out on a weekly basis, and it kind of, you get used to it and you build it and you talk about it and you like it. I feel like Arbitrum was just much better at drawing out the hype, and they got you to do so much more up on their ecosystem. And you've been there for so long, they're like, maybe I'm just going to stick around here now. I've got some ARB tokens, and they were probably much more successful at, generating that. But I guess if you're a layer 2, you've got a couple of different weapons in your tool belt, right, to try to incentivize activity. You've got your airdrop, so there's a strategy around that. Then you've got your sort of emission schedule, and then you've got grants that you can dole out. Like Optimism I think Optimism actually did a pretty good job just in terms of giving out big grants to dApps that wanted to launch on that platform. So it is worth pointing out, it's not like airdrops are the only thing. It's one thing in your tool belt of different in levers to pull.
Yeah, it'll be fun to watch what ZK Sync does, because they've been teasing a token for quite some time as well. You see heavy airdrop farming there as well. But what's interesting is, just based on discussions we've had with the team on our various ZeroX research podcasts that we've had, they seem pretty pro the idea that there will be a token that will be used to decentralize the sequencer. And if that's the case, then we talk about the trade-off between airdrop and long-term incentives. You kind of need those long-term emissions where you're, rewarding validators for participating honestly within your, validating or sequencing process. And that gets into a whole other interesting piece for Arbitrum and Optimism, because they don't have those long-tail emission schedules built into their current token models, and they also don't really have a steadfast way to decentralize their sequencers. So they might run into a problem later down the line that, maybe ZK Sync, by launching their token later, launching their chain later, might have like a leg up. And that kind of like, I guess, counteracts the idea of first mover advantage is everything in crypto.
Do you guys see that Sonny, the founder of Osmosis, actually tweeted out that proof of stake was a mistake? And actually had all these people piling on. And yeah, John Charbonneau came over the top and said, I might agree with you, for rollups and maybe a proof of authority design would actually make a lot more sense, which I thought was pretty interesting, because decentralizing the sequencer is definitely a more complicated task than I think many of us had originally thought. But I want to bookend this discussion of airdrops and actually move into talk a little bit about Solana DeFi. So Dan, you were starting to bring this up earlier. Westie, I know you've been digging around deeply in the data of Solana, but I'd love to just get your guys' sort of viewpoint. Solana originally DeFi was one of the first use cases that was touted on Solana, and you had Serum, and that was the first pretty exciting example. Now I know it doesn't look so great in hindsight, but of a central limit order book that was actually possible on chain. Anatoly did a great job of putting out this vision of sort of consensus at the speed of light and a decentralized exchange that works globally as fast as NASDAQ. And I think it really jazzed everyone up. Post FTX, I think one of the hardest hit sectors in all of crypto was probably DeFi and Solana. But now you're sort of starting to see this rebirth and this phoenix rise from the ashes, if you will, which I think if you've been poking around and paying attention, there's some great founders that are building in that space. So I would love to just get your guys' sort of high-level views on how you're viewing Solana DeFi these days, whether or not you think there's some potential there. Is it all just a smoldering wreckage post FTX, or what's your sort of view on the whole thing?
smoldering wreckage is honestly not a bad description of the current state, but I think that's primed for a renaissance, to be completely honest. So the idea of a high throughput blockchain makes a lot of sense in a lot of different ways. And man, every time I hear a discussion about like decentralizing the sequencer or social consensus or this or that, I'm like, I'm buying more Sol. Like, not financial advice, but it's just every single time that you get into those like steel-headed conversations, it's tough, man. It really is. And so I'm like, one single shard, that idea seems to solve a lot of these problems. And let's just juice the base layer until we can get the throughput to where it needs to be. And like, yeah, there's definitely going to be problems that we run into there, but it's not like the other path has no problems either. So I'm glad we have teams building modular blockchains, and I'm also glad we have teams focused on maximizing the throughput of a single shard. So that's the thesis around why I'm still paying attention to Solana, to be completely honest. It's just the idea that someone is going down the other side of the path where, it's not like it's all sunshine and roses on the modular side either. So that's what kind of kept my attention there. And then once you start digging in, like, there are really, really good teams building. MarginFi and Jito are two teams that that's why I'm interested in them. And I mentioned them earlier for potential of an airdrop, which I have no idea if that's the case, but would be very interested in participating in those ecosystems, most certainly. Jito is building an MEV-focused liquid staking solution, and MarginFi is like this lending protocol. Those are two very core primitives that Ethereum has done very, very well. Obviously, Lido is kind of dominating the game when it comes to liquid staking, but that is taking an increasingly forefront when it comes to the rest of DeFi. We're seeing like fresh DeFi protocols being built strictly around liquid staking. Super exciting to see that kind of formulate out. And that's also now getting translated over to Solana. And just granted the fact that, Solana it's hard to say what was real and what was, just Alameda kind of forged during the heat of the bull run. But, there's still some interesting tech there, and I'm interested in what's to come. So there's teams like Ellipsis being built by, I believe it's Phoenix Labs, not
Eugene.
Yeah. Super excited about what they're building. Just getting the idea of the on-chain order book back. We haven't really figured that out, and I would say DEXs as a whole is probably the most exciting cornerstone of DeFi right now. On Ethereum, you have UniV4, Ambient, Curve V2, their fresh contracts have come out. And then when you look over in the Cosmos, you have Duality and the new era of Osmosis. And then Solana is really no different. You have Liquidity and Ellipsis, while OpenBook is kind of coming back online. So it's definitely not dead, and there's a lot of interesting things being built. And, if you're someone, like, we keep talking about airdrops, so I'll bring it back up. But if you're someone who, like, that's what you want to do and go farm airdrops, then I would definitely recommend not competing against the Cybele bots that are built to be EVM compatible, and go get in the trenches with you and 10 other people checking out Solana DeFi.
Yeah, I think Dan hit the nail on the head there. To me, I think one of the biggest aspects of blockchain that I think we've sort of forgotten at this point is composability. And some people will think, synchronous composability, like within the same block, isn't necessary. But I think it can be a superpower if possible. With Solana, you have the ability for synchronous composability and within like 400 millisecond block times. So you can imagine, once you sort of stack these Lego blocks on top of each other, that you would just have very seamless UX experiences across many different apps. And I pulled up a 0xMert tweet, and it's so funny to see the amount of projects building on Solana DeFi and looking at each one and understanding like the quality of the teams. He has Phoenix, MarginFi, Drift, Zeta, Cypher, Meteora, Jupiter, Mango, Jet. Like, the list literally goes on and on and on. He has an entire thread of all these projects building on Solana DeFi. And once you understand how the pieces sort of fit together from one project to another, you sort of see like, yeah, the DeFi ecosystem is coming back to life. And while like Solana DeFi was sort of plagued by FTX's downfall last year, I think a lot of the teams have hunkered down. We've seen a lot of new teams come on board, and really they seem pretty unfazed by it all. And as soon as we start to see more capital, more users flow back into the ecosystem, I think it's definitely primed for an explosion.
Yeah. I tend to agree with all of that. And what I would just remind folks who sort of look at Ethereum and Solana and do a compare contrast is, I would say in 2019 or 2018, Ethereum did not look like the bulletproof, behemoth market-leading smart contract platform that it does today. All these platforms that we like to point to at early successes of crypto, the Uniswaps, the Aves, et cetera. I mean, these things didn't really exist. There wasn't an enormous amount to do on chain. And actually, the narrative back then was ICOs were a scam, and all of this capital raising stuff that you're doing is illegitimate. And probably Bitcoin is the thing that really makes sense and works. And there's just a lot of, pattern matching that you could do in between the Solana DeFi space today and where Ethereum was in 2018 and 2019. And it's almost an oversaid meme at this point, but I think sub 80 Ethereum is the same thing as sub, $15 or $20 Sol. That's not going to be an opportunity that lasts forever. Not financial advice, So it's worth, and I think you're exactly right. It's a risk reward thing as well, which is, so much is priced into Ethereum. If you, no shade, but if you look at the roll-up space, like how many, $10 to $15 billion, FDV roll-ups can we get before someone says, wait a second, does this ultimately really make that much sense? Or, do you want to look at, the whole market cap of Solana being, sub 50 billion or something? So I tend to agree with you. There's an interesting, before we move on here, there's an interesting cold start problem that I think if Solana solved, they'd be more off to the races. There's this virtuous cycle between liquid staking and DeFi that doesn't quite exist in Solana. So for basically, if you had to do sort of a user journey, right, for people in Ethereum, the very first thing that you do is buy Ethereum on a centralized exchange. Then you move that to a MetaMask wallet. Then you liquid stake that. Then you take your liquid staking token and you use it in DeFi and you compound your yield, right? Taking a minimal amount of risk. The problem in Solana is twofold, is that one, you don't have a robust DeFi ecosystem yet. Or you did, you just had a gigantic 18-wheeler drive right through it. And then two is that the adoption for liquid staking is just so much lower. So you kind of have these two fundamental building blocks that you haven't been able to kickstart that virtuous cycle yet that I think would really kick off a Solana DeFi summer. But they're a great team. Like Jito is trying to solve that. Marinade is trying to solve that. And once that gets solved, I mean, then you're kind of off to the races. And you could either view that as a problem, or you could be like, this is a really solvable, problem. And once this gets kicked off, could be gangbusters.
Yeah, I strongly agree with that. I think you're going to see like a curve like DEX get built on Solana, where it has above average tech that just chucks incentives at the wall, and people will build projects to come make a token to stick it, to pool on that protocol, that DEX, and participate in the rewards ecosystem. You could argue that Frax would not exist if Curve did not exist. If you look just at their liquid staking token, they use a 2-token model, and the unstaked version requires an external yield to be an attractive solution. And so that gets generated through Curve, and that's what Curve was built to do. So it's kind of like this symbiotic relationship for the two protocols. But then you start like zooming out and say, okay, well, how many other protocols have been built on top of Curve? Convex, StakeDAO, Conic, Concentrator, the list goes on. Well, how many protocols have been built on top of Frax? There's also quite a few, and Sommelier, which is a Cosmos chain, actually just integrated Frax. So you see like this flywheel cycle that starts to happen when there's like this one, maybe liquidity hub or incentive hub, or that kind of helps kickstart the flywheel you're talking of. And then you need like a solid lending protocol for sure, because leverage is kind of what spins the entire world, not just crypto. And the other thing I find interesting is Solana, if you just follow a few of their more popular, I don't want to say influencers, but people who are like live and breathe the Solana ecosystem, they are actually focused on building apps that people want to use. And that gets touted heavily by Anatoly himself, which that's also a bit of a culture shift from Ethereum, which not necessarily a bad thing or a good thing. It's just something I've noticed where Ethereum is focused on building out like a scalable solution because that's what it needs to do, where Solana is like, hey, like, let's load this thing up. Like, let's get people on chain. Like, that is their chief focus right now. And I find that super interesting. So we might even see something that's not DeFi related really be the Kickstarter for Solana.
I wonder if they sort of take a page out of ETH DeFi's book, where there's sort of like creative solutions to bootstrap LSDs, whether that be interest rate derivatives. I know Pendle's been doing really well recently. Whether that be, stable coins backed by LSTs. I think there's a lot of creativity going on in the ETH ecosystem that Solana could maybe pick up on and do more efficiently. So I wonder if they sort of take a book out of that page.
I want to move on and get your thoughts on liquid staking, because that's the subject of this series is topic. But before we do, I actually want to plug Permissionless, because we're doing a Solana. First of all, Permissionless is the event that we do with Bankless, going to be the biggest, best event in all of DeFi and crypto more broadly. That's happening September 11th through the 13th in Austin, Texas this year. Dan and Westie are going to be down there, so a little extra incentive. And we're doing a great Solana DeFi panel, which made me think of this. And we're actually going to have MarginFi, Eugene from Ellipsis. We're going to have Lucas from Jito and Bartosz from Cube Exchange, all talking about Solana DeFi. Going to be an absolutely fire panel. We're going to be talking about the roll-up ecosystem, account abstraction, a whole bunch of really cool stuff. So discount code BELLCURVE30. So you get 30% off if you're listening to this. See you there. All right, but I want to move on to liquid staking more broadly and get your perspective, Westie. So you actually wrote a great piece on this for sort of the state of LSTFi in general, and would love to kind of just get your sense of how you break out the ecosystem at a high level, some of the interest, like what's driving activity today, and then what's some of the more interesting experimentation that you see going on there?
Yeah, it's a great question. So I actually split up sort of LSTFi as a whole into 5 buckets. The first one is sort of like leverage staking, where people basically take their LSDs, borrow ETH against them, stake them into LSDs again, and sort of loop that. And Aave made that particularly popular, and more specifically with stETH as the specific LST. And that was actually a major driver in stETH supply growth over the past year, was its use in looped leverage. And so you have Aave as sort of like the main protocol for the loop leverage, but you also have, other leverage protocols such as Gearbox starting to pop up, which do something similar and try and maybe have sort of higher risk strategies, but with higher potential yield. And so that's sort of like the first category. The second is sort of within AMMs and providing liquidity. So because LSTs are correlated to ETH, you can have sort of LST ETH pairs, and you're able to basically not only get the yield from the LST side of that LP pair, but also the yield coming from trading fees, and also potential incentives from DEXs, or through something like a curve model where these LSTs provide incentives to basically bribe voters to drive more incentives to their pools. And so that's a great way to sort of drive adoption. Curve has obviously become the number one DEX for LST trading, but you have Balancer and Aura that have specific sort of designs around LSTs and trying to bootstrap that. And so I think they could potentially give Curve a run for their money, as well as, Uniswap v3 and potentially v4. I'm going to guess they have some sort of LST strategy. And then from there, you sort of have LST baskets, which are meant to like diversify your risk into different LSTs, but really you're adding additional risk because now you have a new smart contract you need to worry about. But you also have the ability to have sort of like a convex-like platform where now that you have some sort of treasury and a bunch of LSTs, you can build products based on that, whether that be, new AMMs or something along those lines, to bootstrap yield and bootstrap, more of the LST in your treasury. And then from there, I think the final two are probably the most interesting, and I've seen probably the most growth as of late, which are LST-backed stablecoins. So you have Libra, I think it's pronounced, where you basically have LST-backed stablecoin, and it's a RAI fork where you have basically no interest loans on the back of your LST. And then you have other projects that are launching that are very similar. You have Prisma, I believe, is launching pretty soon, which is looking to basically enter into the Curve complex flywheel. You have other projects as well. Raft is another one, which is another RAI fork. But basically, they all take different design decisions, whether they're hard pegging to the US dollar, because in the case of Libra, the stablecoin itself is accruing a portion of the staking yield that's backing it. And as a result, there's basically higher incentive to hold the stablecoin than there is to borrow against the LST. And so as a result, the peg obviously is going to increase against the US dollar, and that could have a problem when it comes to those that have borrow positions. And so hard coding to the US dollar might pose a lot of risks to the protocol. But at the same time, soft pegging to the US dollar, obviously you're not going to have the same stability. And so there's sort of trade-offs that different projects make. And there's a lot of experimentation here. And I think these are the projects that have grown, I think, the most out of all of LST-Fi on a percentage basis. Libra has seen immense growth over the past month, particularly. And so that's like a pretty interesting area to look at. And the final one is interest rate derivatives. So basically, Pendle is a good example because they've been growing like crazy recently, where basically they're a split token protocol where you can basically take a yield-bearing token and split its principal and yield components. And from there, you're able to have certain strategies that you wouldn't be able to otherwise utilize, such as trading sort of the yield on a specific token, or maybe buying a discounted token prior to its expiration date. There's a lot of different strategies that are involved. And as a result, Pendle has been able to basically create LST pools for these split tokens that are incentivized, and a lot of people have locked up their capital to deploy certain strategies and increase their yield. And I think, as we go forward and staking becomes sort of like the risk-free rate almost within DeFi, I think there's going to be a lot of interesting products around trading the interest rate around ETH. And so, those final two buckets as a whole, I think, are the fastest growing and the most exciting.
The Pendle stuff is really interesting. I admittedly haven't done too big a deep dive there, but does that like effectively give you the ability to like go long ETH staking rewards?
Yeah, it's interesting. So like I said, you have like a principal and a yield token, and each of those have an expiration date. And as you get closer to the expiration date, if you hold the yield token, you basically get paid out that yield, and the actual value of the token sort of falls towards zero as you get closer to the expiration date. And the principal token is sort of like discounted versus its par value. You can buy it discounted and then wait until it gets to its expiration date, and it's going to converge on its basically actual value. And so as a result, you can like sort of trade the yield tokens. If you think all of a sudden there's going to be a ton of MEV coming up in ETH staking yield, you can buy the yield token, hope that it appreciates in price because it's pricing in its future yield. Or you can maybe short the token if you think there was a huge MEV event and it's not going to be sustainable and it's going to come down. So yeah, there is a way to basically trade the yield token. I'm not sure if it's the most capital efficient or like the best way to trade it. I think there are other models that are coming out that are probably better when it comes to specifically trading the yield on stETH. But at the same time, it's pretty good for what we got now. And obviously they've been able to bootstrap that liquidity.
Yeah, there's a lot of interesting experimentation going on. Westie, one thing that I've heard that might actually act as slight pushback, but I want to get your perspective on it, is in doing the research, and we actually recorded with Hasu this morning, and that's going to come out next Tuesday, which is a great episode. But his perspective is that LST-Fi is a little bit of a meme, and actually some of the majors in DeFi, they all basically accept liquid staking tokens as collateral. So if your advantage is that you only work with liquid staking tokens, then that's not ultimately really a moat, and that you're just going to get eaten by the majors. So what would you respond to that pushback?
I think that's a pretty fair take. To me, like LSTs are a great bootstrapping mechanism, especially now that we're only at like 20% of ETH staked. And I think there's a lot of room to grow when it comes to liquid staking growth, staking as a whole. And as a result, like right now, if you're a new protocol, it's the best way to capitalize on that and create TVL and create excitement and activity. And so like going back to the airdrop conversation, using your token now to bootstrap that liquidity that's sticky, that stays in potentially your treasury or within TVL of the protocol, I think is a really good move because, I don't think there's going to be many opportunities to bootstrap this amount of capital in the future. And so, yeah, the way I see it is this is sort of like bootstrapping mechanisms for these new protocols, and it's sort of what they do from here. That's the bigger question. So obviously just having LSTs back your stablecoin is probably not the most optimal, but sort of starting with that and sort of capturing the narrative and then pivoting from there, I think is where we're going to separate the winners from the losers.
I want to move and talk a little about a as sort of a combination of DEX and AMM design, which I feel like is becoming a much hotter topic. You guys have done some great interviews on 0x Research with Doug Colkett of Ambient Finance and most recently Sunny Agrawal of Osmosis. But I want to talk a little bit about Blur and your thoughts on NFTs in general. So we talked about this last week, so I don't feel the need to go way more in detail about it. But Azuki had what I would call a pretty disastrous mint the last week, where they raised an additional, I think, 38 million or so, like just under $40 million worth of capital with these new elemental Azukis, and it's basically the exact same art, which is, it's almost funny, right? And the community was very upset. I understand there's going to be some sort of a lawsuit, and the floor. It's actually one of the first times I think I've ever seen crypto markets respond perfectly efficiently. They doubled the supply of tokens, and the floor price fell 50%. So, you know, we got an efficient market here, guys. That finally makes some sense. But since then, the Pac-Man, the founder of Blur, came out with a tweet. One of the interesting things that I frankly didn't understand a lot is the Azuki floor seemed like it dragged a whole bunch of other NFT floor prices with it. So nothing else was down 50%, I don't think, but it was all down 20 or 30%. And now you're starting to see this idea of how the death of NFTs. And Blur, Blur's founder, Pac-Man, came out and basically had this sort of defensive Twitter post and said this wasn't Blur that killed NFTs. It was, he actually frankly pointed the finger at Azuki. But I'd be curious to get your guys' take on the state of the NFT market and what impact, if any, do you think Blur had?
I don't know. Maybe it's a controversial take, but I think PFP, NFT, the whole craze around that corner of the market, that was a 2020, 2021 phenomena. I think this is going one direction and it's not up. The idea of digital art being in the form of an NFT, that will never go away. That will be a continually growing market. Luxury art, well, that's just how it works. And the fact that it's now digital seems like a great idea to me. I think, my generation probably leans towards favoring more digital things, and the one generation below me will most certainly be favoring more digital things. So
yeah. I'm
bullish on the idea of NFT-based art, specifically art. And the Goose is a great example of this that just recently sold for around $5 million. I'm bullish on that idea. I'm also bullish on the idea of using the underlying technology of NFTs to power very interesting crypto-based solutions. An example of this would be like a block-based futures market. So the rights to order the transactions within a specific block is inherently valuable, and each block is different, non-fungible. So using an NFT to represent that the rights of ordering a certain block becomes a very interesting thing. And so that's like a cool use case where NFTs could power more of like a actual crypto native product. Another example is maybe like Uniswap using NFTs for their LP position. So not necessarily the best example, just because there's a lot of inefficiencies around that, but nonetheless, it is like interesting experimentation with the underlying technology. But I just don't see how the next, like the PFP collections, 10K of these like shitty pictures, it's just not, I'm bearish. I don't know how else to say it. I'm not excited about it. It is not interesting. And I do think it will go away. There will be a new form of gambling that takes the place in the role of the PFP NFT marketplace. That's just kind of my 2 cents on the matter. But I don't think it's Blur's fault. I think they are just a market participant. And like if I'm an Azuki holder and I got the exact same metadata NFT as one I already had, yeah, I'm going to be pissed. But am I really going to be excited if I got a picture that just looked different? Like no, you just gave me another worthless picture. And like, no, they weren't worthless before, but I don't think the floor price would have taken much of a different move. Again, you doubled the supply and it got cut in half. Like what else did you expect was going to happen? I don't know. I'm just not excited about the state of NFTs, and probably won't continue to be.
I think there's two different discussions here, which is what is the long-term future of PFP collections? And then there's the sort of proximate cause of the NFT bear market and Blur's impact, if any. What goes up must come down. I think I don't think anyone should be wildly shocked that the market for JPEGs went down as much as it had a meteoric rise, and this was always inevitable to some degree. I do think it's we were talking about this a little bit before we got online, but I think there is liquidity cuts both ways a little bit, and there was a great Uncommon Core episode, one of the early ones, where DGen Spartan laid out this framework for why DeFi topped so far before the rest of the market. And the idea was, he actually talked about Sushi Swap being the cause of the DeFi summer top, and the reason was that was, it was sort of the fork of Uniswap, and it was the first one to experiment with Pool 2s and do all this very risky, very extreme incentivization of liquidity on the platform. And it basically, if in a bull market when everything is going up, that's fine. But if you are a whale sitting on a whole bunch of illiquid DeFi tokens and you see this as the golden, maybe last opportunity to sell, you're going to sell, right? So there's probably a similar analogy here between Blur and Blend, where if you were sitting on a whole bunch of JPEGs and you realized that they were not going to the moon and ultimately you were looking to sell, but up until that point, the liquidity conditions just hadn't been fit, and all of a sudden you had an opportunity to sell, you would probably sell. So I think there's a direct analogy to be made there. So liquidity kind of cuts both ways, and I come down on Pac-Man's side of things. It's not their fault, I don't think. This was always just sort of bound to happen. But then I also think that there's a discussion to be had about the future of PFP NFTs. I would agree with some parts of what you said, Dan, but I would also push back a little bit. I think there's an interesting question. Frankly, it would be an interesting poll to get done across different age groups. But, if you could spend, $2,500, keep in mind that's, about 1 ETH, right? Like 1 ETH on a nice suit or like a sick NFT. I don't know. It's that I have to think about, right? Because depending on what I get with that NFT, if I feel like it actually affords me status, who knows? I mean, I'm addicted to Twitter. My God. I mean, I go on Twitter far more than I wear a suit. And that's kind of a cute example, but I had talked about this becoming a Pudgy shill here, but I talked to Luca, one of the co-founders of Pudgy, and he just had such a refreshing take on, what it took to build a brand. And look at what they've done. They've actually sold penguins. They're talking about licensing the image of Pudgy. It's just go old fashioned, just slap some Pudgy penguins on pajamas, and maybe you sold the white pajamas for $10. You sold the license image for 15, and you have a great income stream there. So I think, to be honest, there were a lot of founders that were pretty opportunistic in the NFT space. They saw the chance to just raise ungodly amounts of money, but they didn't necessarily know how to actually, once they've launched the NFT brands, how to build that IP. And what you'll probably see is the wheat gets separated from the chaff, and a whole bunch of founders that are have more actual experience in building lasting IP and generating revenue step in and do that. And I think the last thing that Azuki was a great example of is, I don't know if you've ever heard the framework of you have to earn the right to launch a new product. Like, it's very tempting to, this isn't really working, let's just launch a new product. Really the product greats over the years have kind of this framework of your customers, you need to basically saturated what your customers want, really hit it out of the park with your current service offering before you can launch another. I think it's the same thing with mints, right? I think Azuki would have gone very differently if there was this whole sort of character and identity introduced by the original collection, and they had done all of these different things to monetize it. And then within that general sort of storyline and community, there was a reason to launch another set of NFTs that complemented the Azuki originals. They were slightly different. There was a different identity. Then that mint would have worked. But if your whole business model is to just mint new JPEGs and create a perpetual motion machine, then that's not going to work. So that was a bit of a rambling explanation, but that's kind of my thoughts.
Way too much logic when I could just go sell some JPEGs for $38 million. But no, I mean, I agree with you. I think there will definitely be PFP NFTs that stick around and stay around and will always be a thing. There is value in culture. I do buy that narrative. I just really don't see the NFT market exploded last bull run. And all it literally was taking a random series of pictures and selling them, and then them going straight to zero. And that happened over and over and over again. And maybe it's too optimistic to think that market participants will be wiser over time. But I will eat my words if that happens again.
Yeah. And I agree with everything you said, Mike, that we're going to have some winners come out of this. But at the same time, like for me, I think the most valuable projects, the ones that will have the highest returns, are those with the clean slate that are sort of the new shiny objects that have new ideas, new like creative things that they're building. You know, the 10,000 PFP collection, I think, is kind of done. Like that's been done a million times. So once people start to iterate of new sort of creative ideas, I think people are just going to latch onto that. And because you have, you know, a clean slate, you don't have a price chart to look at for history. Like people are just, I think, going to bid the new projects as opposed to the old.
Yeah, I tend to agree with that too. All right, I think that's probably good for NFTs. Well, maybe we could close on this idea of DeFi 1.0 catching a bid. I actually was reminding myself when we were talking about DGen Spartan. Have you ever seen his DeFi bear progress chart o-meter thing? Yeah, so I was following it for a little bit, but I saw a tweet the other day. All right, this comes from, so it's a Mika Honkasalo tweet, that we are actually right now, in July is month 35 of the DeFi bear market. So obviously 36 months is something that DGen Spartan pulled out of his ass. But, you know, it has been, it's funny because DeFi was a little bit idiosyncratic with the rest of the market. It led the market, it experienced the bear market earlier, and it's really just been down in the depths for such a long period of time. And I'd be curious, you know, Maker, it actually looked like was catching a bid for the first time in quite a long time recently, and that with even the backdrop of Endgame, which I'm not sure anyone really understands, you know, is sort of acting as a headwind. So I'd be curious, what do you guys think of the current state of DeFi? Is it posed for, you know, some potential? I know it's tough to call after almost 3 straight years of downward price action, but what do you guys think?
Yeah, I think part of the price action we've seen over the past couple of weeks has been really like kicked off by comp specifically. Like comp has been the outlier. And I think that was people anticipating the super state drop from Leshner and a potential, you know, partnership or some synergies between the two projects. And as a result, I think a lot of other projects there was sort of like a beta trade on comp specifically. And I think that drove a lot of the specific price action. But at the same time, like DeFi 1.0, a lot of these projects are definitely primes because if you look at their charts, they've been basically down only since mid 2021. It's been pretty sad, to be honest. Like especially Maker has been hit pretty bad. And Maker, especially as of recent, has gotten a lot of traction when it comes to, you know, onboarding RWAs, having new loans. Like the DAI savings rate is now over 3%. And they're, I think, on pace for like 9 figures in profits over the next year, which is pretty incredible. And I think has been overlooked simply based on the fact that people don't want to buy a token that's like falling constantly over time. And so as a result, I think, you know, Maker specifically has bottomed at this point and is continuing to increase their revenues over time. You know, Synthetics has pivoted a lot over the years, but they're another one that, you know, tops the charts constantly when it comes to applications generating revenue on a daily basis through their perps product. So they're another great example of a DeFi 1.0 project that's sort of been oversold and has like a clear roadmap towards profitability. And, you know, you can point to a lot of these other projects as well as being in a similar boat. And I think it's a pretty funny coincidence that bear market timing does line up to DGen Spartan's sort of timeline. But yeah, I think DeFi 1.0 is definitely poised for a comeback.
Yeah, I don't have the numbers right in front of me right now, but if you want to take like a fundamental approach and if that's just, you know, there's merit to that, and also, you know, the reality of that not being the best metrics for crypto in its current state. But if that's what you were looking at, you know, on a price to fees or price to sales ratio, Maker actually is one of the few protocols you could say was arguably undervalued. And to your point, Mike, they do have like a huge headwind in the end game. There are probably 5 people that truly understand what the end game is, and those 5 people work for Maker. One of them is Rune, so there's really not that much clarity around it, but it could be a headwind, it could be a tailwind. It's really just too hard to say. So there could be some pricing in of just execution risk there, to be completely honest. But yeah, to Westie's point, they're they're generating cash flows, and that might be exciting at some point. There's a lot of talk in the crypto Twitter circles, of course, that cash flow is bearish, right? Because then you can actually price these things, and turns out we actually don't like the prices that those turn into. But the reality is Maker was cheap relative to its peers, so I'm not too surprised it's catching a bid here. Aave kind of has this narrative of its stablecoin Go coming out soon. The current status of that is like any day now, but to be fair, it's been any day now for a couple of weeks. Aave Companies has built the contracts, audited the contracts. They are good to go. Aave Chan has handled the governance side of things. It's greenlit from both angles, just kind of honestly waiting for the on-chain proposal. So there's a bit of alpha. Keep your eyes on the Aave governance contract for the Go proposal. But the thing that I'm finding interesting is, a lot of these DeFi 1.0 projects had genius teams that actually wanted to build a true DeFi protocol that solved, some sort of financial problem. And their teams never gave up during the bear market. And so now they're 2-3 years into their life, and they're putting out the best versions of those products. Again, we've seen Maker has created a fairly resilient stablecoin, and they're continuing to improve on it, kind of migrating away from the PSM into a more like AMO model. And then you have Curve that updated their DEX contracts to the most advanced passive AMM model we've seen, and they've created a revolutionary lending protocol that kind of removes the need for, or mitigates the need for, a hard liquidation. It kind of goes to this collateral conversion process. And you've seen Aave launching their own stablecoin. So you've seen this like continued development from these large, well-respected teams in the space, and they currently have the best products. Curve has the most TVL, second most trading volume. Uniswap's got the most trading volume, launching UniV4. Aave's got the most borrow outstanding of any protocol. Like, if there were assets to go buy in DeFi, like it doesn't shock me that these are the ones getting the true attention right now.
Yeah, I agree with that take. It's probably worth pointing out as well that some of the majors, Curve, Aave, Maker, they all seem to be converging on a similar business model. And it actually reminds me a little bit of, there was a race in CeFi back in 2019 or 2020 to build Prime Brokerage. And it started from a bunch of businesses started from a very different vantage point. Some of them started from the perspective of lending, the BlockFis of the world. Some of them started from the perspective of custody, the BitGos or the Anchorages of the world. Some of them did cap intro or whatever they did. But everyone converged on this idea of Prime Brokerage, and you're starting to see a very similar sort of convergence within the business model for some of the DeFi majors. So DAI originally started, or Maker obviously started as a stable coin with DAI. Aave was exclusively borrow lend, and now you're starting to see all of those models converge. And I think I am torn about how I think about this, because I think in the one sense, it just depends on the organizational structure behind them. Because if you're a traditional sort of company, this makes all the sense in the world. The bear case for looking at something like the DeFi protocols that exist today is you take sort of a non-prop banks do a whole bunch of different things, right? Like an investment bank has a whole bunch of different functions. You could make the argument that something like Aave takes a very unprofitable part of that bank and just makes it a software. And you're like, well, how exciting is that really? I'm not 100% sure. Banks are much more exciting when you have all of those different services bundled into one. So you can have certain services that can be loss leaders, and then you can be net interest margin or some of, kind of lead into some of the higher margin activities. On the other hand, you have to have a very rigid hierarchy, and the actual corporate structure of a bank makes a lot of sense for that. Whereas one concern that I have, like the DAOs that I kind of like, are frankly the Lidos that are trying to limit the surface area of what they do and minimize the decisions that governance can make. These protocols are going in the opposite direction of that. And they're actually expanding their managerial surface area, and they're expanding the amount of complexity that the DAO has to manage. And that, I could see the pros and cons for, frankly, both sides of that argument. And I think we just have to wait, and time will tell how it all plays out.
That's an interesting point. It's just like governance overall, like no one's figured that out. No one even has gotten close to figuring that out. It's kind of cool we're seeing new ideas come to fruition, right? The idea of sub-DAOs is actually being executed on by MakerDAO. Frax has been, working on their Frax Gov, which is like some sort of trade-off between having a team that's using a multi-sig to really push forward change and innovation and like actual execution, but having the token holders be like a gatekeeper to some critical level changes. That seems like a really cool model. And so we're kind of seeing some interesting exploration there, but I think I tend to agree that less governance is better. It's just like that's one of those things that it needs to be an end state that you build towards, not like somewhere you start at. Like, hey, we're a no governance protocol. Okay, well, we're a rapidly growing industry, and you're going to need to make some changes in the current state. But I like the end goal of kind of reducing overall governance.
And I think that the final thing to add there is there's probably a sort of stack, which depends on how close you are to the base layer infrastructure. Like if you consider Ethereum sort of the base layer infrastructure and it's trying to create like a money or commodity that powers smart contracts, maybe the next layer up is what Ethereum has decided to outsource, but are still critical functions for Ethereum. So that could be block building in the form of Swab and Flash bots. That could be liquid staking in the form of Lido. That could be restaking in the form of Eigenlayer. But those things, it's not actually antithetical to making a good product, but decentralization is a requirement for the product, actually. And then maybe one layer up from that would be like borrow, lend, and DEXs, and then maybe there'd be games on the top. And let's be honest, no one really cares that these games don't need to be as decentralized as Ethereum here. Those are games. It doesn't matter as much. So I think it also depends on where you sit in the overall stack as well. One last thing I'd love to get your take on, guys. So Lido recently passed a proposal to transition a bunch of its Ethereum and its treasury to stETH. So on the one hand, I could see this being good. stETH is yield bearing, so that's some extra essentially net interest that Lido's treasury is earning that it wasn't earning before. On the other hand, a treasury is supposed to be a rainy day fund, and you'd really need that treasury if there was a problem with stETH itself. So it seems like you might be taking on a little bit of unnecessary risk there. But then at the same time, if there was some kind of catastrophic slashing event with stETH, probably all that ETH in the treasury isn't going to help anyway. So I'd be curious to get what are your guys' takes on this?
I think your last point hits the nail on the head. Like quickly pulling it up, Lido has $14.5 billion of TVL. I think the proposals, correct me if I'm wrong, but I think the proposals for $20 million of treasury ETH to be converted to stETH, that's not even gonna get close to covering you. Plus, if something critical happened to staked ETH, Lido is probably toast anyways. So, I don't hate the going all in on your own token thing in this case. This is a bit of like dog fooding it, like, hey, like we're doing it with our treasury, you should too, kind of thing, maybe. But more so, it's just like, look, if we put $20 million in there and we can earn 5% a year, we can actually pay our core team off of staked ETH yield, and that would be kind of a cool thing to do with that. So I think it actually makes sense. I like the idea.
Yeah, I'm for the most part for it, but I think Mikey brought up a great point, and it's like, what is the ETH in the treasury supposed to be used for? Is it supposed to be a rainy day fund where if stETH falls below peg, you can use that ETH to basically bid up stETH back to peg? If so, then you want ETH in your treasury and not stETH. But I'm guessing that most of the treasury is going to be used to pay for devs or for certain initiatives, etc. And so having it in stETH, I think, is fine. Yeah, it kind of like increases the risk of a slashing event, but really not enough for it to be an issue because they're already sort of taking that on as a protocol. So like as a whole, I don't think it's a bad proposal. I think it's pretty good. But if it were me, I'd be a little more cautious, maybe like 80% stake and 20% not. But yeah, overall, not too bad.
What's your take on this, Mike?
I don't know. Nobody runs these treasuries how I would run them. So I guess I'm just not thinking the same. I think the treasury is the one thing you don't want to take even an ounce of risk on. And it's actually kind of similarly to how I think about, my holdings of ETH versus staked ETH. This was the analogy that I had with BlockFi as well, which is, if you think that the asset that you're holding is going to appreciate, it's high risk asset, so might appreciate 10 to 20x over the course of the next, 5 years or something like that on a conservative, estimate for some of these assets. Are you going to add an additional layer of smart contract risk that I can't diligence at all, for an extra 3 or 4% per year? I know Warren Buffett would get his calculator out and tell me how much money I'm losing by not doing that, but that's just not how my brain works. And I don't know. That's the side. I would run things a lot more conservatively if you waved a magic wand and I was in charge of everyone's treasuries. It would basically all be I would make the assets masked liabilities, which is also why I like ETH, because if there was ever some sort of, flashing event, even a more minor one, and you had to do a payout or you had to defend the peg, like I think you could actually make a really good case for ETH sitting in Lido's treasuries. But if you're almost any other protocol, I'm sitting in basically 100% USDC. I think that's just the safe thing to do. Because
you actually got in my head about that. I had most of my ETH staked as staked ETH, and then you got in my head about that, and I'm like, what am I doing? Of course, the other half of mine is like, time locked for a year in convexed in Frax ETH. So the complete other end of the spectrum. So I'm like, all right, maybe we meet one half on the zero risk side and one half on the max risk side.
You know what though? It's a good reminder that this time when you don't feel like taking risk is the time to take risk. The time to be bearish was 18 months ago. That was the time to be bearish. This is not the time to be bearish. You want to be bullish in this period of time. So maybe that's a good thought to end it on. Not financial. None of this is financial advice, for the love of God. And guys, if you're listening to this on the bell curve feed, definitely head over to 0x Research, because these guys are, I'm biased, but these guys are awesome, and they dump out some alpha every single week consistently. So definitely head over and check them out at Blockworks Research as well.
Yeah. We'll put a link in the show notes to the Blockworks Research fresh new landing page. Shout out to Dennis, our CTO. Really went above and beyond on that one. But yeah, Mike, it's been fun, man. Thank you.
This was fun, guys. Thanks for joining me.